Hello, welcome to the Acres Financial Winning in Retirement Classroom session. I'm Brian Akers, President and founder of Acres Financial Group, also a certified financial planner practitioner.
And I'm Jeff Akers, Vice President of Akers Financial Group, also Brian's cousin. I've been working with him since 2000. And we want to welcome you to some education about required minimum distributions and qualified charitable distributions.
I hope you're ready to go and hope you understand that these are very important classes for people that are turning 70 and a half or turning 73 in the year 2024. So as we begin the class, all right, hopefully everybody can see their screen.
I hope so. I can see it.
All right, so let's get some business done first, Jeff. Let's start with disclosures that we're going to cover about Acres Financial Group and the people that work here at Acres Financial Group.
All the good required stuff that we have to show.
Yeah,
So we have a broker dealer. It's called Arcadios Capital. They're located in Atlanta, Georgia. And that's how we can be stockbrokers, Series 7 licensed, so we can buy and sell mutual funds, stocks, bonds, that kind of thing. We're also investment advisor representatives through Arcadios Wealth, also of Atlanta. Now, we're not owned by Arcadios and we don't own Arcadios, but they provide compliance for us. So they look at things that we do, make sure that we're on the straight and narrow. Now, keep in mind as we go through this information that we're not giving you specific advice for you. We're trying to tell you general information that can be used. To get that specific advice, you really need to come see us, give us a call, talk to us so that we can understand your specific situation. Then we can give you specific advice for you. But for today, we're looking at general information just so that you know, and we can kind of start that conversation a couple of steps ahead.
Acres Financial Group is ready and willing and able to help you at any time. Our team of advisors, you just got to contact our company. You go through our website, acresfinancial.com, and we'll be able to talk to you about your exact situation. So let's go ahead and get started, Jeff. When do people have to start taking RMDs? And what is an RMD, Jeff?
So RMD is a required minimum distribution. When you put money into a traditional IRA or 401k, it comes out pre-tax, so you're not taxed on that contribution. And then any growth inside the IRA is tax deferred, so you're not going to pay tax until you take money out. So the IRS decided that eventually they're going to make you take money out so that they can tax it. Well, that age used to be 70 and a half. You heard Brian earlier say that this is important if you turn 70 and a half. Several years ago, that was the required minimum distribution age. You had to start taking money out. Then they raised the age to 72, and then last year they raised it to 73. Now, if you were born in 1960 or later, your age, RMD age, is actually 75. So they've been raising the age because we've been living longer. So if you just take a look at how old you are now, you'll know whether or not you have to start taking required minimum distributions.
All right, that's good, solid information, good foundational thing to get moving on to our next slide. That next slide is this RMD, the required minimum distribution. What is the math behind a minimum?
Right. So this is how we do it. We have to take the value of your IRA on December 31st of last year, whatever that value is, and then we divide it by a life expectancy factor that the IRS gives us. So you see the table on the right, and you see your age there, and then the next column is your life expectancy according to the IRS. So at age 73, your divisor, the life expectancy factor, is 26.5. So we're going to take the value of your IRA on December 31st, divide it by 26.5, and that gives us a number, which is your required minimum distribution for this year. In this example, we've got someone that's 73 years old. The divisor's 26 and a half. They've got 3 IRAs totaling $650,000. We calculate the required amount for each account, and then we add them up. And you'll see why adding them up is important here in a minute. But in this case, for $650,000 in IRA money, your total required minimum distribution would be $24,528.30.
Now that is your minimum once you hit 73. Now 73 is the year that you turn 73. In that first year, Jeff, they can wait, right? They can wait to the next year if they wanted to.
You could wait until April in that first year, but if you do that, the year you turn 74, you have to take your required distribution by December 31st. So you'd end up taking 2 distributions in the same year.
Mhm.
And in this case, instead of taking a round number, $25,000, you'd end up taking a total of $50,000 roughly. And that can mess with your taxes a little bit. We want to make sure that you're staying in the same tax bracket. You're not paying extra on Medicare and things like that. So even though you have a little extra time in that first year, we generally like to take your distribution in the year that you turn 73. So anytime before December 31st.
All right. So what I want you to understand is that this is a spreadsheet that we actually do for our clients at Acres Financial Group. Whenever we do this was actually an example of last year in 2023. So we took, if you see on the very bottom here, we took the end of the year 2022, and that person turned 73 during the year. So it's about the age you obtained during the calendar year. And then I'm going to go back to this little required minimum distribution chart. This is put out by the IRS, and this is a newer chart. Came out in 2022, I believe. They upgraded it. And so 73 is 26.5, but if you're 83, it's 17.7. So you end up taking a higher percentage out every year that you live, and the chart runs way down all the way till you're 117 years old.
Actually, it goes to 120 now. And when you're 120, you've got 2 years to live, according to the IRS.
Well, Jeff knows everything when it comes to this, so we're going to make him in charge of our RMDs. Well, that's what we do at Acres Financial Group, right, Jeff?
That's right.
All right, so Acres Financial Group, one of Jeff's duties at Acres Financial Group is making sure that all of the proper laws are applied in calculating RMDs for our clients with the money that we hold here. Now what we got to do is explain some more complexities on RMDs, and that is the concept of aggregation. Now, Jeff might be aggravation to many of us, but Jeff is very good at teaching aggravation. I'm sorry, can you say it right?
I'm aggravating to Brian, but for you, I just want to teach you about aggregation. It's another big word.
Not irrigation.
No, not irrigation, aggregation.
All right.
So you'll see on our screen here that to the left, you've got IRAs. You can take all of your IRAs, add them up like we did on the spreadsheet before, and that total amount that you have to take, you could take that distribution from any IRA you want. Now, you could take it from all of them. You could take it from one of them. You could split up and take it from 2 of them, but you can aggregate your IRAs all together. Then in the center, you see 403Bs. You might have worked at a hospital or a school or something like that, and you've got multiple 403Bs. You're allowed to aggregate your 403Bs as well. So you could take it from one of them, 2 of them, or take it across all of them. You cannot mix your 403Bs with your IRAs. There's a wall between them. Then over to the right, you see 401ks, TSPs. These you cannot aggregate. So if you have 4 401ks from different places you've worked, when you take a required distribution, you have to take the amount for that 401k from that 401k. So there's no mixing and matching, no aggregating for your 401ks, TSPs if you're a federal employee, those kinds of things. So it's important to know these, because if you think, well, I've got an IRA and a 401k, my total amount that I have to take out, $50,000, I'm just going to take it from my 401k and leave my IRA alone. you're going to end up getting in trouble if you do that because you did not take a required distribution from your IRA. So keep this in mind. IRAs go together, 401ks are totally separate, and the 403bs, they can be together with other 403bs, but with nothing else.
Yeah, so the reason we believe advisors should be involved is that you need to understand what you have. And prior to 73, you might want to consider consolidating and rolling the different aspects like 401ks, 403bs into an IRA where you get a lot of freedom on how you withdraw. We typically have a withdrawal plan that we really build out, the retirement income plan, and we like to control what we're doing over time. If you're in a 401k and you're an employee, not the owner of the company, but an employee, and you work past 73, there are laws that allow you not to be forced to take out. But that's all subject to the plan design. And if you're still actively working and qualifying for that 401k, which is true in some cases, right, John?
Right. Now, if you've Brian mentioned that, sometimes this is a reason that we like to roll over to IRAs. Personally, I like having some IRAs that are protected so they don't go down when the market goes down, and some IRAs that are invested in the market so they can go up and down. And then in a year where the market does well, we'll just take the winnings off the table from the ones that went up. And if the market didn't do well, then let's take it from something that didn't go down. We have that option in IRAs. We don't have that option when it comes to 401ks mixed in there.
Yeah, many 401ks will basically take the withdrawal from across the portfolio allocation, even if we have the money sitting in money market to withdraw. So what we try to do is figure out the rules if we have to under the 401ks and what to do best. Now, when you take an RMD out of these accounts, these are normally all pre-tax money that all need to come out. And so that's fully taxable to you as you withdraw. And so one of the big topics we want to try to cover is an idea called a qualified charitable distribution.
All right. So qualified charitable distributions, Brian said at the beginning, 70.5 is important, 73 is important. And then we talked about how required distributions change their age from 70.5 to 73. Well, qualified charitable distributions, you can do this the year you turn 70.5. So when they first came out, it was when RMDs were at 70.5. They raised the RMD age, but they left the QCD age the same. So even if you don't have to take money out of an IRA because of RMDs, you can still use this to give money to charities. So a qualified charitable distribution when you're 73 or older does help satisfy your required minimum distribution. And you can do $105,000. It is indexed to inflation. $105,000 is the amount for 2024. Next year, based on inflation, that should be a little bit higher. So you can satisfy up to $105,000 of your required minimum distribution using a QCD. The beauty of a QCD is you give that money to charity and therefore you do not pay tax on it. Brian calls it an above the line deduction because it's right on the front of your 1040 where it shows it a distribution, but it's not taxable. And that can potentially help reduce the amount of Social Security that's subject to tax. And it lowers your adjusted gross income. So it can also help when it comes to calculating whether or not you're subject to that Medicare, I call it a penalty, IRMA. So tax reporting for the QCD, it's similar to IRA rollover. If you've ever done a rollover from a 401k to an IRA, you get a 1099-R and it tells you how much you took out. Then there's a code G for rollover, and that means it's not taxable, so it doesn't show up in that right-hand column. Now, with a QCD, they don't have a special code to say it was given to charity, so you're going to have to remember that to tell your tax person what was given to charity. But on the tax form, the 1040, you put QCD on the dots between column A and column B, and then the amount that actually goes over there to column B, the the one that gets added up for your adjusted gross income, that number is going to be smaller because of the amount that was given to charity.
Yeah, so just showing you or telling you about the how to do it, how to report it. What I want to talk about is the why. So imagine that under the current tax law, which is the Tax Cut and Jobs Act, it runs through the end of 25. And in that law, they've really raised their standard deduction way up by the combining of our exemptions and what used to be our standard deduction. And, and that's caused people actually to not be able to itemize their charity. So the idea is this: you might be given to charity and not being able to deduct it. So there is no tax advantage on your charitable gift. So what this does is this: it then brings your IRA where you have to pull out where it would be taxable. And by giving it to charity, you basically lowered the taxation of it dollar for dollar. These
Right.
have to be a qualifying charity. It can't be your kids, can't be a dog, can't be anything like that. But it can be Humane Society. It can be charities for children, just not your children. It could be
Right.
zoos, elephant funds, different studies and grants and churches, synagogues, all kinds of ways that you can put money to charity. And we can do multiple distributions. Some of our clients will have it set up to send money every quarter directly to the charity. Sometimes the checks go straight to the client and they turn it into the charity. Now you can't take a deduction and do a QCD. You just got to remember to use the QCD properly on your tax reporting line.
Right. Yeah, you can't do the uh, Schedule A, itemizing your deductions with this gift to charity. But it is a way to take advantage of the deduction. It's actually better than a deduction because it's never taxable. But there's a way to take advantage of that and the standard deduction. Like Brian said, it's really high right now. And if you're 73, hopefully you don't have a mortgage, so there's no mortgage interest. You could only deduct up to $10,000 of state and local taxes. So really, unless you give a ton of money to charity, you're not going to be able to itemize anyway. And compared to that standard deduction, you're not going to get credit for everything that you gave to charity. This is a way to get credit for everything that you're giving to charity.
The IRMA is the income related monthly adjustment. That affects people on their Medicare premiums, where if they make too much money, they show too much money. The QCD is a better way to report charity than the charitable itemized deduction because it lowers the income dollar for dollar. It's a big deal. So make sure you understand this concept. The concept is that the checkbook IRA is where you pull the money from, not your bank checkbook that you pay your bills from. That means you don't want to give your charity directly out of your checking, give it directly out of your IRAs. The forms are things that our company provides our clients. It helps this money to get to where you want it most. I think it's a big deal.
That's right. And at the end of the year, the IRA custodian is going to send you a 1099-R. So like I said before, when we were talking about rollovers, there's not a special code on the 1099-R to say that it was given to charity. So you're going to have to remember that, have it written down. That's something that we do for our clients, is give them a list of here's the charities that the money went to, because you'll have to tell the person preparing your taxes. They're not going to have any way of knowing unless you tell them, so that it can be reported correctly on your tax return and take advantage of, like Brian said, this above the line deduction.
All right. We're going to be talking about this next thing, which is what if you forgot to take your RMD? So the rules have changed a little bit. They used to charge you a penalty of 50% of what you're supposed to take out. And then right now they've made the law a little bit easier, right, Jeff?
Well, yeah, that's one way of thinking of it. The penalty was dropped from 50% to 25%. So think, oh, that's good. It was cut in half. Now, there was always a way to say to the IRS, I'm sorry, I forgot. I went ahead and took care of it. You could fill out a special form and send in that 5329 form and ask for a waiver.
Mhm.
And most of the time, that waiver would be granted. So you wouldn't end up paying the penalty. But now they've lowered the penalty to 25%, But if you correct the error within 2 years, that penalty is 10%. So you can still request the waiver. It's just there are some tax folks that say, well, because they say in the first 2 years, if you fix it, the penalty is only 10%, they're going to charge the 10%. They're not going to waive that. This is a new thing. This change is pretty recent. So we haven't seen whether or not that waiver is granted if you find the error and fix it. But we want to avoid the penalty, so thou shalt not forget to take your required minimum distribution in a timely manner in the year in which you reach a certain age.
Yeah, so what we try to do is this. We want to understand your history and we want to make sure you've done the right thing. We call that your financial fingerprints. New clients, we really got to make sure that you've been doing things right. That's why we look at your tax returns for the last 3 years and sort of understand the history. If you're coming as a new client before 73, then we can prepare for this and understand in planning really what should you do to try to avoid RMD in the future. And that's where there's a whole presentation on Roth conversions and how you can pay tax now and never again for those younger than 73. Now, we're going to just cover a little bit about Acres Financial Group, how we can help. We can calculate the RMD for you by using the data you provide on your previous year's statements. Now, then we can determine which way is the best way to take your RMD. You got to remember that it's the aggregation, not the aggravation of calculating on your own. How about that, Jeff?
Yeah, nice recovery there.
I was faking that a little bit, trying to trick myself.
Yeah, struggling with aggregation, but most people struggle with aggregation.
Yeah, that was the what I was trying to display in my word usage.
Yes. So you
Oh,
saw the spreadsheet earlier. That's something that we use to help calculate your required distributions. Of course, if the money is in IRAs that we have for you, we can get those numbers and calculate the RMD for you from beginning to end. But you might have an IRA or a 401k or TSP or 403b or something somewhere else. We'd need you to give us that information so that we can calculate what that required distribution would be.
right.
And Brian mentioned that we could do Roth conversions before you turn 73. And by doing that, we pay the tax now, and then it's never again. Because in a Roth IRA, it's not taxable when you take it out after 5 years, after a conversion, and it's not subject to required minimum distributions. You don't have to take money out of it. So it's a way to lower your future required distributions. Once you reach 73, we could still do Roth conversions, but you have to take your required minimum distribution first, and then you can convert above that. One other thing that we help folks with is the inherited IRAs and inherited Roth IRAs. These are subject to required distributions. It's a different table that we use for life expectancy for those. And there are different rules depending on when the person who left it to you passed away.
Yeah.
So this is something that we'd have to meet with you, go through the details of the situation to help you figure out what to do with those inherited IRAs and Roth IRAs.
Before you inherit money, call Acres Financial Group so that we can use things like inherited IRAs and inherited Roths. What's cool, Jeff, is RMDs do not apply to Roths. So when you do saving in Roth in your retirement plan throughout your life, you're not required to make distributions. That's a great deal on the Roth IRA. So that's why we love Roth. We love after tax. These are all pre-tax programs we've been talking about today. 70.5 allows you to take money out for charity. You don't have to take minimum withdrawals. If you are younger than 73 this year, you can actually do Roth conversions, but you can also do Roth conversions after 73, but you have to take your minimum and then Roth convert above. All very, very important things for you to know. The hardest part we have to do, Jeff, now is say goodbye, which I think is one of the hardest things. Can you begin singing our theme song as we exit?
No, you don't want to hear me sing, but we are done. So folks can be thankful that they're not going to hear me sing.
All right, so thank you very much for attending. We are Acres Financial Group, Brian and Jeff Acres, Winning in Retirement Classroom. Winning in Retirement is our radio show podcast. We ask you to check us out on any podcast channel that you like. You also can listen to us live on our radio station, 680 AM, 680 AM at 10 AM on Saturday mornings. Then at 11 AM, you switch the dial to 1057 The Fan.
Yes. And if you don't live in the Baltimore area, it's a podcast. You can listen to us on the internet.
And radio is great. You don't have to see us as much.
Yes. Yes, I tell people I have a face for radio.
All right. Well, we thank you very much. Good job, Jeff. Appreciate it. Enjoy our slides after this that'll explain how you can connect with us at Acres Financial Group.